In today's podcast, I want to share with you 40 property investment lessons that I've learned over the last 4 decades. And the aim of that is to help you gain some clarity in the current many mixed messages that you're hearing in the media, because I want you to develop the financial independence you're looking for. And hindsight's a wonderful thing. I've been investing for close to 5 decades, so I want to share with you some lessons to give you, as I said, some clarity. Now, if you're a regular listener or viewer to this podcast, you know I usually have a guest with me, but every now and then it's just a solo chat, me and you. And these lessons, I was going to say this lesson, but there's actually 40 lessons I want to share with you. Short, sharp, but I believe powerful, are so important. I want to chat just me and you, so that at the end of today, you'll have some ideas of what's ahead, what to do, and how to outperform the markets. So let's get started.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hindsight's a wonderful thing, isn't it? But let me ask you a question. With the benefit of hindsight and knowing what you know now, if you had the opportunity to do so, would you have bought a property investment 40 years ago, 45 years ago? And I bet your answer would be yes. I mean, realising that the median price of properties in Sydney back in the early 1980s was around 68,500, not 600,000, 68,500 back then. And you could have bought a median price property in Melbourne for just $40,000. Oh, look, let me ask you another question. What if you didn't have the benefit of hindsight, and there we were both back in 1980, 40, 45 years ago, and you were just about to invest in property. And I told you that in the next year or two in Australia, we'd fall into a recession. And that in 6 years' time, negative gearing would be removed, only to be introduced a couple of years later. What if I told you that there was going to be a stock market crash in 1987 and a severe recession in the early 1990s? You know, that recession we had to have in Australia, meaning that in the first decade of owning a property, you'd have had to face all those headwinds. Knowing that, would you have still bought a property back in 1980? Of course, with the benefit of a time machine and you still being back in the 1980s as you plan to buy your first property, I'd also warn you about the upcoming AIDS scare and the SARS pandemic and the Asian financial crisis and September 11th with the Twin Towers in America and the global financial crisis and the coronavirus-induced world recession. Would you still have had the courage to buy a property back then in 1980? The answer for many people would be no. Why on earth would I invest in property knowing there are so many challenges, so many problems, so many risks ahead? Of course, anyone who wouldn't have bought a property would have missed out on some amazing wealth building opportunities, wouldn't they? Now, how do I know this? Well, I was already investing for about a decade back then in the early 80s, and I did buy another investment properties. And over the years, the capital growth I achieved from my investment properties allowed me to keep adding to my portfolio, meaning that today I've got a significant cash machine that gives me the lifestyle choices I was looking for back then. Of course, along the way, I've had some great investment wins, but boy, I've also made more than my share of mistakes, and I learned many lessons from those, things I wish I knew back then. So today in this podcast, I'd like to share with you 40 property lessons that I learned over the last 4 decades of investing. I'm just going to quickly discuss those with you. I'm not going to go into depth in all of them. I can't in the time we've got allowed, but I hope you're going to get some insight to give you the courage to take action in the current challenging property markets, not knowing what's ahead, but knowing what was behind. So the first lesson I want to share with you is our economy and our property markets move in cycles. Booms never last forever, but neither do busts. And that's mainly because most of us get swept up in the optimism or pessimism of others. Don't be surprised when they come round, and don't overreact. This will help you being avoid being sucked in by the booms and spat out during the busts. The second lesson I'd like to share with you is, despite the ups and downs, the long-term trend for well-located capital city properties is strong rises in value. And this long-term growth of property values is underpinned by Australia's strong population growth and our demographic changes, as well as the underlying wealth of our nation. So in the short term, there's lots of factors that affect our property market, like consumer confidence and government interference and interest rates. But over the long term, there have been lots of studies about this all around the world. What underpins the growth, or in some countries the stagnation of property values, is our population, or actually family formation, and that's going to keep growing, as you know, and also the wealth of the nation, that we can afford to keep buying properties. Third lesson, even though they're armed with all the research available in today's information age, economists never seem to agree on where the property markets are heading, and usually their forecasts are wrong. You see, property market movements are far from an exact science. It's much more than just the fundamentals, which economists can look at with their spreadsheets. They're relatively easy to quantify. But what moves the market are consumer sentiment, investor sentiment. And since the economists aren't on the ground at our property markets within their offices, they tend to forecast property values a bit like they forecast share values. Doesn't really work. Fourth lesson is, every year we get hit by an X factor. And I've done podcasts about this before. I've written blogs about it. You know, every year we get not the X factor like the music show, but a black swan event, unforeseen events or situations that blow out all our carefully laid plans, some for the upside and some for the downside. And then every decade or so, we have a major event where the world breaks, such as COVID just a couple of years ago, such as September 11th, such as the global financial crisis where things go awry. The next lesson I'd like to share with you is that there are multiple property markets in Australia, and even within our capital cities, there are multiple property markets divided by geography, by price point, and by type of property. So when somebody tells you about the Australian property markets doing this or the Sydney property markets doing that, don't pay attention, because this type of information is of no use. You need to examine what's happening to the property markets on a much more granular level. Lesson number 6 is, property investment is risky in the short term, but secure in the long term. It's definitely not a way to get rich quickly. Yes, I know there have been some markets over the last couple of years that have had double-digit growth, like Perth, like Adelaide, like parts of Brisbane, like parts of northern Queensland. But I've seen these hotspots before that are chased by investors, that are pushed up by investors. And those markets I've just mentioned in general now have, I guess, reached their peak. So I'd be very careful about investing in those now this year, and I'd be investing in undervalued markets that are at the beginning of the upturn stage of the property cycle. And I've found that it takes the average property investor around 30 years to become financially independent. Often the first 10 years or so, they keep making mistakes. They're learning what not to do as much as what to do. And then you need a number of property cycles under your belt to grow a substantial asset base. The next lesson is that since property is a long-term game, don't look for what works now. Instead, look for what has always worked. History shows that this year's hotspot is going to be next year's not spot. So don't make 30-year investment decisions based on the last 30 minutes of news. I'm sharing with you 40 property investment lessons I've learned over the last 4 decades of investing. Lesson number 8 is residential property investment is a high-growth, relatively low-yield investment class. Wealth is created by building a substantial asset base, and you do this by holding good investments for a reasonably long time, reinvesting the income you're receiving and allowing your capital gains to build and take advantage of the magic of compounding leverage in time. Lesson number 9 is, at times, you're going to get no growth, no capital growth at all, or property markets are going to go down a bit. But strategic property investors manufacture their capital growth through property renovations and development, something I've been doing for, well, I guess the 4 decades that I've been talking about. Probably didn't do that in the first decade or so while I was investing. The 10th lesson, really important one, is residential real estate's a game of finance with some houses thrown in the middle. The next lesson is taking on debt isn't a problem. Not being able to repay debt is an issue, meaning that cash flow management is a critical part of wealth creation. As I've already said, property investment's a game of finance with some houses thrown in the middle. And it's important to understand that there are three types of debt. What I'd call bad debt against depreciating items, necessary debt such as the non-tax deductible debt against your home, and then there's good debt against depreciating assets like income-producing residential real estate. The 12th lesson I want to share with you today is that successful investors have a long-term strategy to grow their wealth and use the correct asset protection and finance structures as well as insurance. They insure themselves because if you think about it, one of your biggest assets is your income earning capacity. So successful investors know what to do and also know how to protect themselves. 13th lesson is strategic investors don't only buy properties, but they buy themselves time to ride out the cycles by having financial cash flow buffers in place in facilities such as offset accounts or lines of credit. The 14th lesson is one I learned from Warren Buffett when he said wealth is the transfer of money from the impatient to the patient. So really the aim of property investment or any investment really is understanding the concept of delayed gratification. Do the hard things now so you have an easier time later rather than do the easy things now and have a hard time later. A lesson I learned along the way also is that the media is not there to educate you, but its job is to get you to click on the links so that they can receive revenue from the advertisers. So don't rely on the media for your investment strategies and in general for advice. I mean, you just have a look any day and you'll see the very mixed messages in the media. That's why I start every one of these podcasts by saying my aim is to help you get clarity in the chaos of all the mixed messages that are there. Another lesson I learned along the way of these 40 lessons I want to share with you is there's always going to be someone out there telling you not to invest in property. They know of somebody who's lost money, or they've heard of somebody who's lost money, or they've made mistakes. Don't listen to them. But the 15th lesson is there's always going to be somebody out there telling you to invest in property. So my suggestion is understand their vested interests. They don't usually have your best interest in mind. So when you do get advice, and I believe you do, and I believe you should pay for advice, make sure that you're paying for independent strategic advice, not for somebody who's got a product or a service to sell. Now, again, at Metropole, let me give you a shameless plug and I guess a disclaimer. We do sell our services at Metropole. We help our clients safely grow, protect and pass on their wealth by giving strategic property advice. But we have no properties for sale. We've never sold them. We don't ever get any kickbacks from developers. We have our own teams on the ground. So therefore, when we actually help our clients implement the strategic plans we make for our clients, our buyers agents are on the ground. They don't do a FaceTime call to the selling agent like others do. We only invest in the big capital markets that are capital city markets that have got substantial depth to them. And we have a detailed research department, and all the research that's around, I guess, is pretty well common knowledge. The thing is, though, that you need the perspective to interpret it, and then you need the research to see what's looking ahead. When I've changed the way I invest by looking forward rather than the rear vision mirror, it's improved my results and those of our clients. So if you're keen to take advantage of this property cycle, use the lessons we've learned, get better at your own investments, whether you're a beginner or really experienced, why not have a wealth chat with one of our wealth strategists? At Metropole, we're much, much more than just buyers agents. We help our clients safely grow, protect and pass on their wealth through strategic wealth and property advice. So I started to say this because you've got to understand, I said, be careful with people with vested interests. We always start off by putting a strategic plan together for you. And yes, we get paid for that. But by helping you plan to become the person you plan to become, we're going to stop you making mistakes, not just telling you what to do. Hey, maybe that goes into my next lesson, number 18, which says savvy investors surround themselves with a great team and they're prepared to pay for their advisors because they see that as an investment, not a cost. I suggest you pay for your mentors and join a mastermind group. Now, if you want to be part of a great mastermind group, if you want to get good mentors around you, why not join us at Wealth Retreat 2025 on the Gold Coast in May this year? I've got a great faculty of people, but it's also a great community of already very successful investors, business people and entrepreneurs. But don't count yourself out. Go to wealthretreat.com.au have a look about it, just express your interest, and we'd love to have a chat with you to see if it would suit you. 19th lesson is if you're the smartest person in your team, you're in trouble. I guess that's one of the reasons you go to Wealth Retreat and surround yourself with people that are even smarter than you. Lesson 20 of the 40 lessons I want to share with you that I learned over the last 4 decades is you're going to make investment mistakes along the way. And you're either going to end up paying a significant learning fee to the market, or you can pay your advisors and learn from their experience and minimize your risks. The 21st lesson I'd like to share with you is no one really knows what's going to happen to the property markets. Just look at all the forecasts that have happened over the last years and how wrong they've been. But more than that, there are 27 million property experts in Australia. Everyone seems to have an opinion about property, but you know what they say about opinions. They're like belly buttons. Everyone has one, but they're basically useless. So be careful who you listen to. Sure, it's important to have mentors, but make sure you're listening to somebody who's not only built their own substantial property portfolio, but's kept their wealth through a number of cycles. Recently, it's been very easy to pick some of the hot spots and look really smart, when in fact a combination of luck and timing was what created some successes over the last couple of years. But I've been around the block a number of times and seen how last year's expert isn't around anymore. Currently, there are too many what I'd call enthusiastic amateurs out there offering investment advice. The next lesson is don't listen to who most property investors listen to for investment advice. Look, accountants are good at doing your tax, mortgage brokers will help you get a loan, and financial planners are good at minimising your risks. But none of these professionals are well positioned to give you property investment advice. The next lesson I'd like to share with you of the lessons I've learned over the last 4 decades is timing the property market's just too hard. It's much better to buy the best asset you can afford, a quality asset, and hold it in the long term. The truth is successful investors know how to create wealth at any point in the cycle. Have you noticed how some investors seem to do well in good times and even do better in bad times? Market timing really isn't important to them. On the other hand, others do poorly in good times and even worse in bad times. Market timing seems to have very little effect on them either. Interesting, isn't it? So don't try and time the market. Having said that, let me give you a caveat. Anyone who's bought in the Melbourne property market in the last couple of years, their properties have underperformed. There's no question about it that they could have done better buying elsewhere in the short term. Remember, in the long term, property investment grows. Well, Melbourne properties are going to outperform other areas because they're going to revert to their mean. So I believe at the moment there's a great window of opportunity to look for the right sort of properties in Melbourne, because at the moment the differential between Melbourne and Sydney is the greatest it's been as long as I remember. And in fact, house prices in Perth, Adelaide and Brisbane are almost those of Melbourne as well. So there is a market timing opportunity, but not to get in and out. Just, I guess if the market's offering you an opportunity, why not take advantage of it? The other lesson I learned along the way, or another lesson I learned along the way, is that any property can become an investment property. You just kick out the owner and put a tenant in and it becomes an investment, doesn't it? But less than 4% of all the properties currently on the market are what I would call investment grade, that will deliver wealth producing rates of return. The next lesson is don't rely entirely on property data. It can be misleading and it can be twisted to say almost anything. And that's because property investment is part science and part art. You need to understand and interpret this data, which is, I guess, the science bit, but you also need an on-the-ground perspective to employ that data, the art side. And so currently, over the last couple of years, I've been seeing a lot of younger, inexperienced buyers agents buy in, particularly in northeast Queensland, northern Queensland, particularly in the east, the western, in Western Australia and in Adelaide, where they've been buying property sight unseen. They don't know why one side of the street is better than the other. Or, a great example I often give is that in Sydney, one side of the street's got magnificent houses that have got views of the Sydney Harbour Bridge and the water, and the other side of the street's got houses that have got magnificent views of the houses that have got views of the Sydney Harbour Bridge and the water. That's an extreme, but you really need on-the-ground experience. So all the buyers agents at Metropole are ex-selling agents who have that experience and understand what's going on and why certain parts of a street or a suburb are so much better than others. So don't rely only on data. And as I said, property investment is part science, data, but also art, having the perspective to understand that. The next lesson I want to share with you are that there are 4 ways you can make money out of property: capital growth, rental income, tax benefits, and what I'd call forced appreciation or manufactured capital growth through renovations of property development. But all these income streams aren't equal. In fact, in my mind, tax-free capital growth is the most important. So while cash flow is important to keep you in the property game, it's really capital growth that's going to get you out of the rat race. Another lesson I want to share with you is that you're never going to get rich from earned income or saving. You need your money working for you even when you're asleep. So investing it in income-producing residential real estate and using the benefits of leverage and compounding to grow your wealth is a great way of doing things. I guess you need two businesses in my mind. You need your either physical business or profession or job as your cash flow business, and use that to service and grow your capital growth business, your property portfolio, until it's big enough that eventually it's going to give you the income you require and you can leave your main job or profession in the long term. Another lesson you've often heard me say in these podcasts is that location will do 80% of the heavy lifting of your property's capital growth. So while you can improve a property, you can repaint it, you can pull it down and build something new there, you can't change the location. So location will do the majority of the heavy lifting, and we like investing in areas that are gentrifying, that are growing, that are going to always be in strong demand by owner-occupiers as well as tenants. But we're wanting more affluent owner-occupiers to be living in those locations, pushing up the value of properties around you, and also tenants who aren't just a week away from broke, because your eventual income from your property portfolio will be dependent on your tenants' ability to keep paying higher rents over the years. So therefore, demography is a real important part of the research we do at Metropole. The next lesson, again, I think it's a Warren Buffett quote, is be greedy when others, I just remembered that, be greedy when others are fearful and be fearful when others are greedy. So don't follow the crowd, because the crowd's usually wrong or late to the party. In other words, don't do what most property investors do, because we know the statistics show that property investors, the majority of 50% sell up in the first 5 years or so, according to CoreLogic's reports. And of those who stay in the market, we know that 92% of investors never get past their first or second property. So therefore, don't do what most property investors do. And as I said a while ago, don't listen to who most property investors listen to. Otherwise, you're going to get the same results as them in the long term. In the short term, you're possibly going to do well. But as I've said a few times already, those hotspots I'd be very, very cautious about. Now, the next lesson I would like to share with you, and I've sort of talked about it already, is treat your property investments like a business. There's no room for emotion, so track your cash flow, regularly review your property's performance, and make decisions based on evidence. See, we find that when we do client reviews at Metropole, for clients who've come to us and we're helping them buy properties or helping them plan by putting a strategic plan together, they've often held properties not bought by us that they bought a while ago that are not performing as well as they should, but they've spent so much time, effort and emotion buying them, they say, oh, it's not costing me anything, I'll hold on to it. It is costing. It's the actual opportunity cost of using the money elsewhere. Not easy to do, to work out, should you sell, should you keep, is it just a short-term reason why the property is not doing well, or is it a long-term problem with the property or its location? And that's why we use very sound, sophisticated software to help our clients plan. So when you become a client of Metropole, you actually get access to the information, you get access to the program that we use so that you can do the what-ifs to see what's going on. So again, track your properties with data and not with emotions. Another lesson I learned a long time ago is don't look for fun or excitement in your investments. Your investments should be boring, but they should give you what you're going to require to make the rest of your life exciting. So people get excited by flipping, by doing renovations, by going to auctions on the weekend, by trying to do quick deals. If you want excitement, go bungee jumping, go trail bike riding. Property investment should be boring. The next lesson is diversification is for people who don't know how to invest. Look, you'll never become an expert doing 100 things once. However, you can become a master by doing one thing 100 times. So property investment is a bit hard to diversify because it's expensive, but I wouldn't just be buying in another area when you found a suburb that's doing really well. However, over time, as you grow your portfolio, you should diversify to a degree, but only when you've got a big enough portfolio. So let me explain. I've got townhouses, apartments, houses is in my property portfolio. I've got commercial, industrial, retail properties in my portfolio, and I've got them in a couple of states. So there are ways of diversifying, but first get it right and stick to those areas. The next lesson I'd like to share with you as we're getting into the last of these 40 lessons I've learned over the last 4 decades is having the right mindset is critical to investment success. Your outside world is a reflection of your inside world because your thoughts lead to your feelings lead to your actions, and your actions lead to your results. So that's why for many years I've been running a mentorship program, and why the first part of Wealth Retreat is actually about getting rid of a whole lot of limiting beliefs. And it's interesting that every year, while there's a lot of very, very successful investors and business people there, we all, including me, still have limiting beliefs that hold us back. So we've got to clear those out and then make room for new empowering beliefs, and then all the information is going to work. Otherwise, you have the limiting beliefs and you're not going to use the power, all the information that we share over the 5 days at Wealth Retreat. Remember, go to wealthretreat.com.au after you've listened or watched this podcast so you can find out about it and express your interest. The 38th of the 40 lessons I want to share with you, there's always risks associated with investing. Don't be afraid of failing, because the biggest risk is not doing anything to protect your financial future. Look, sometimes negative experiences, mistakes and failures can be even better than success because they teach you something new, something that will help you get to the next win, but something that a win probably won't ever teach you. However, we're often so driven to get things right that we fail to see the value in the things we got wrong. We spend our time wishing we'd done it differently, or maybe not doing anything at all because the fear of making mistakes holds people back. Boy, have I seen investors paralyzed by the fear of not getting it right. If you get it wrong, learn from your mistakes, make it count, do it differently next time. One failure can, with time, create many successes. The second last lesson I'd like to share with you today, but every podcast I'm going to keep sharing lessons with you, but the second last lesson I want to share with you today is don't waste your time worrying. I've done more than my share of worrying in the past, and I've learned that most things that you fear will never happen. Things that you worry are going to happen never do. They're just monsters in your mind. And if they do happen, most likely they're not going to be as bad as you expected. So in my mind, time spent worrying is time that you could spend identifying opportunities and taking action. And the last of the 40 lessons I'd like to share with you today is never give up. You'll have failures along the way. In fact, I'm a real success at failure, but each time I've been knocked down, I got up again. You need resilience to be successful. So there you have it. 40 lessons I've learned in the last 4 decades of investing. But since I've been investing for probably over 50 years now, I've learned even more lessons along the way, and I share those with my guests and with you each time we have this podcast twice a week. So my message to you is always keep learning. The markets will humble you if you don't check your ego at the door.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message for you today, I'd like to share with you the concept that you probably don't believe what you're practicing every day. You don't even know what you're practicing. You see, every day without realizing it, we're all enrolled in a masterclass, taught by ourselves, attended by ourselves. So the mindset lesson I want to share with you today is you improve not just at what you practice intentionally, but by what you do repeatedly. Look, fact is you get better at whatever you practice. And also, when forced to consider, I guess everything is practice. So let's take a moment to think about what this really means. Every action, reaction, and minute spent scrolling through your iPhone or reacting to a post on social media, that's all practice. What skills are you honing with that daily practice? It's really easy to see what some people are practicing, isn't it? There's an ever-growing crowd perfecting the art of outrage on social media platforms. They're becoming experts at reacting quickly and loudly, often fueled by a sense of injustice or annoyance. It's a skill, but perhaps maybe not the most beneficial one to nurture. And then there are some who've become virtuosos of victimhood. Boy, I see those a lot on my YouTube channel. They've got a keen eye for spotting personal slights, real or imagined, and perhaps subconsciously the art of feeling that they're being wronged. This too is a form of practice, a preparation for life, looking out from under a cloud. Oh, and let's not forget the planners. What are they practicing? They're masters at drawing up great designs for their lives, for the day, for a project, and yet they never get started. Their plans, so beautifully crafted, remain that, just plans. But here's the kicker. It doesn't have to be that way. Each of us has the power to change what we practice daily. Look, you've heard me say it before. You've got to become the pilot of your life, not just a passenger being dragged along, which means we choose what skills we wish to perfect. So consider this. What if you started practicing gratitude every day? You've heard me say before, I do every morning before I get up. I think of 3 things I've been grateful for that happened yesterday, not things that happened in the past. And I've got to do that because otherwise I kept saying the same things all the time. So start practicing things that are going to help you enjoy your life more, be more powerful. So one is practice gratitude every day. Or maybe you should practice your skills of listening deeply to others, paying attention. What if you practice patience, kindness, or the art of following through on your commitments? Sure, changing what you practice will require effort, but in my mind, the potential rewards are immense. By consciously choosing what we practice, we can transform not just our own lives, but also influence others in a positive way. So my question to you is, what are you practicing? Is it what you truly want to excel at? If not, remember, it's never too late to learn a new part or rehearse a better role or to practice being the perfect you aspire to becoming. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?